Hey, everybody, this is Chuck Marone with Strong Towns. I want to talk to you a little bit today about how multifamily units are priced and the way that interest rates are impacting our ability to bring them to market today. When we look at a multifamily housing unit, let's say a 20 unit, a 40 unit, maybe even a 200 unit building, what we're looking at is something that has a certain cash flow to it. The units are rented, that rent brings in cash. The cash can be applied to payment. The idea is that the cash that you bring in creates the value of the building. When we look at a single family home, you can look at two single family homes and you'll say, well, this one has granite countertops and a jacuzzi tub, and this one does not. So this one has a higher value than that one. Commercial real estate or multifamily real estate is not valued in that way. It's valued based on the rent that you can receive. Let me just say, residential construction should be valued this way a lot more closely too. It's not, but I digress. This is the way that multifamily units are. So let's say that you can rent your units in your 200 unit complex for $1,000 each. That $1,000 each will relate to a certain value and a certain amount of payment in terms of a loan that you take out that you can support. Let's say that the market softens for some reason, and instead of $1,000 a month, it's only $500 a month that you can charge. That's a dramatic price drop, right? It's $500 a unit a month that you can charge. What that actually means is that your multifamily building is worth half as much. It's worth half as much as it otherwise would be. So when we look at the way these buildings are financed, the thing that I've been running into now, and I've talked to a few people who work in this industry who are delivering these types of units. And one of the problems they're having is they're stuck. They're having a difficult bringing new inventory onto the market. And one of the reasons they're having this trouble is because interest rates have gone up. When you finance a building, during the construction phase, you have a construction loan. You are looking to roll that over into a final loan, and then that loan will be bought up, bundled with other things, securitized, all that. That final loan has a payment schedule, right? Like, here's how much we expect to get from rents. It will also have a financing schedule. Here's how much our monthly financing costs are. With interest rates going up dramatically in a short period of time, or at least in the time frame of this construction cycle, people are getting to the end of their loans and they no longer cash flow. The payments that would need to be made to roll this over into a permanent loan, those monthly payments that whoever buys it is going to have to make, because interest rates are higher, those payments are higher, and now the building doesn't cash flow. That means one of two things. Either one, we're going to have to lower the price that we're going to sell it for. In other words, we got to the end of the construction process. Now we need to divest of this property. We're going to have to take a big loss on it. People are very reluctant to take a big loss. Or we're going to have to increase rents even more than what we are anticipating in order to get that payment and interest going forward, so an investor will buy this house or buy this multifamily property. There is a softening of rents right now. And I realize that we have all this talk about affordability. Overall, in the real estate market, in the multifamily real estate market, there is slowing pressure on increases and actually some signs of softening. The idea that we are going to do massive increases of rent to make up for this interest rate gap is a big question mark at best. And so what has happened is a lot of multifamily units are sitting in limbo. They're waiting for the market to kind of push things into the next phase. Either interest rates are going to go back down, in which case we can roll these things over and they'll start clearing and things will start moving again, or things are going to start to break. People are going to have to lose money on these transactions. They're going to have to lower rents. They're going to have to see lower rents. And the multifamily market is going to have to, in a sense, break and reset at a different rate. This is actually impairing a lot in the market. It's not only impairing the immediate kind of delivery of units, but it's impairing the startup of units. Because if you're looking out and saying, we're going to undertake a project, and we're not going to be able to sell this or go to market for 2, 3, 4 years because of permitting and all the construction things that go into it, our interest rate risk right now is really, really high. And so we're going to slow this down. We're not going to undertake as many units. We're not going to go through this process. We are going to slow things down. And that is what we are seeing. These are two opposite effects, right? One pushing up rent, one pushing down rent. And you see this tension. And what really needs to happen is that something is going to break. You will know that things are breaking when you see interest rates come back down, because really what tends to happen is that interest rates go up and up and up until things break, and then interest rates will go back down to accommodate. We'll see if that happens this time. We're in a massive housing bubble, so I'm not really sure.